Last time when India elections happened, on one particular Monday morning, the kind of like initially they said BJP is going to win. On a Monday morning, they said Congress may take lead. On that particular day, market also tanked. The following day also it little bit tanked. Each and every asset management company comes up with something called a fact sheet. Is it mandatory? The answer is it is not mandatory. But is it a best practice? The answer is yes. One of the frequently asked questions is like, should I go for an NFO or should I go for an existing fund? The correct answer for this is called as it depends. For example, if the market is at a rock bottom, what is meant by market is at a rock bottom? Market is at a rock bottom means your PE ratio is around, let's say, 19 times. Or your PE ratio, that is the last trailing 12 months PE ratio is only 18 times or just around 20 times. What we'll say is that is an existing fund is absolutely fine. Why you should go for an existing fund is that is automatically you will get deployed in the stocks immediately. That means if I'm going to invest, let's say 10 lakhs of rupees, the entire 10 lakhs will be invested in equity market on the same day. So that is an excellent thing for going for an existing fund. Not only that, you know the track record of the fund manager for last 1 year, 2 years and 3 years, whatever is the funds that he has managed, then you can go for an existing fund. Not only that, every month, each and every asset management company comes up with something called a fact sheet. Is it mandatory? The answer is it is not mandatory. But is it a best practice? The answer is yes. All the mutual fund companies publish a fact sheet around 15th of the month, maximum around 15th of the month. Some of the asset management companies publish either on the 1st of the month or 2nd of the month. For example, Quant Mutual Fund. Maximum by the 3rd of the month, they will send you, all the investors, they will send one link saying that the fact sheet of the last month is attached. So if you go through the fact sheet and if you're convinced about the portfolio, you can go for an existing mutual fund. By the 10th of the month, all the mutual fund companies have to say what are the portfolio changes that they have done in the previous month, and that will be coming in the form of an Excel sheet. Exactly what is the current holdings. Now we have invested in certain softwares like Engine Premium or whatever. Now what happens is it captures the portfolio changes in the last 5 months, 6 months or 12 months. It is having those kind of data points. Now, if you are very convinced that the portfolio manager is very active on the portfolio, irrespective of the portfolio turnover, he sees that either he increases the position or he decreases the position, and he ensures that depending upon the forward looking of the market, he makes changes to the portfolio. I think you should go for an existing fund. So these are the advantages of investing in an existing mutual fund, and we also try to do it. Same thing for SIP. When it comes to SIP, we generally don't go for an NFO based SIPs. We generally go for an existing fund which has been there in the, let's say, for 2 years, 3 years and 5 years. And sometimes we take a balance between an reputed fund house which has been there with several lakh crores with a new fund house also, so that the fund manager is able to generate an alpha for you. So these are the situations where we go for existing mutual funds. What are the conditions or what are the situations under which you go for an NFO? For example, let's say we are doing this in the month of July 2025 and the current situation is market is going to be little volatile in nature. What is meant by volatile in nature? For the next couple of weeks, we never know whether the funds whether the earnings will go up or whether the earnings will go down. We really don't know. We are talking about August first week where Trump is going to come up with the latest set of changes on the, let's say, tariff related policies. Whether it will have a positive impact or negative impact, we really don't know. And for example, any other political situation or geopolitical situation or any other war related situation will develop. Our suggestion is that we go for a new fund offer. So what are the advantages of going for a new fund offer? When you go for a new fund offer, what happens is people say that you get the NAV at 10 rupees. Yes, obviously you get more number of units. That's absolutely fine. But it doesn't matter that whether you have to go for an existing fund or a NFO, because value matters rather than the number of units. The second important thing is the fund manager will have a fresh perspective. He will have a fresh pair of eyes. For example, if I am going to build a portfolio today, maybe what I will try to do it is, I will not try to build more on, let's say, TCS and Infosys, because considering US may have a tough time in the next 5 or 6 months, I will be building a portfolio based on India-centric portfolio. or I may build a portfolio based on banking and financial services. I may build a portfolio based on pharmaceutical. So what happens is if you give the money to a fund manager now through an NFO, he has at least 30 days to build the portfolio. Even within the 30 days, if he's going to invest only 65%, which is absolutely fine, the remaining 35% can be in cash. So there are situations where the market is little volatile, you are not able to decide, you think that you want to have a market timing. So in that particular situation, what we try to say is that NFO is much better. Has it delivered value? Has NFO delivered much better value than an existing fund? There are certain situations where NFO has delivered excellent value. For example, let's talk about Indian elections. Last time when India elections happened, on one particular Monday morning, initially they said BJP is going to win. On a Monday morning, they said Congress may take lead. On that particular day, market also tanked. The following day also, it little bit tanked. There was one particular fund starting with W, they got the NFO money and then they deployed entire money on that particular day. In a span of 3 to 4 days, what happened is, we and I know what happened to the election result. BJP came to power, not with the same kind of majority, but still they came to power. What happened was, there's a 10% market run happened in a span of 5 days. So by investing in this NFO, what happened is, you would actually capture that bull run also. Similarly, there are situations where it has worked out really positive and sometimes it has not worked really positive. So NFO, I will generally say that depending upon the market situation, depending upon how the funds are, I generally recommend NFOs. And whenever I recommend an NFO, I will also participate. I will also invest in the same NFO in a considerable amount, so that when tomorrow if somebody is going to ask me a question have you invested in this NFO? The answer is yes. But I am not sure whether you will be able to ask such kind of tough questions to your banking relationship manager. Has it delivered negative returns? Yes, there are certain situations where it has delivered negative situations, not because of the fund manager, but because of reasons beyond the control. Now let me touch upon a very important point. Important point is called as concentration risk. So because I worked in a company called TCS for about 15 years, some of us got something called employee stock options. That time it was called as ESPS, Employee Stock Purchase Plan. So we got something like that. Now what happens is, a lot of TCSs became emotional and then they started holding on to that stock. Now in January 2023, the price of TCS was around 4,500 rupees a share. And people said it will going to touch 5,000 rupees a share and they were holding on to it. During the same period, I would say in 2023, leave alone the month, in 2023, there is a new mutual fund which came something called as Quant Technology Fund. So I told my investors saying that you just dilute, let's say 5% or 10% of TCS and then try to put that money into this Quant Technology Fund. I will also give you a link of that particular one, a LinkedIn article in this particular description. If you go and see, the performance of Quant Technology Fund was 15% more as compared to TCS going down by 5 or 6% during the same time period. Now what happens is that instead of investing all the money into one particular stock, which is a concentration risk, instead of doing that, you put it in a set of stocks which has large, mid and small, like a Quant Technology Fund, you generated more alpha. Not only that, after 12 months, there's another fund which came in called Edelweiss Technology Fund, and we went to the same set of investors and then I told, let us dilute 5% of TCS and then let's go and put the money in Edelweiss Technology Fund. Those people invested in Edelweiss Technology Fund, today they are sitting at 13% absolute profit, whereas if you talk about TCS, it has gone down by 13%. So net their clients have made 26% in the whole process. So my suggestion is that all these things participated through NFOs. So my suggestion is that don't ignore NFOs. Look at the market timing, look at the fund manager, look at the philosophy, look at what is the value addition that they are trying to bring based on a number of AMCs that you have, and combine it with what we discussed in the last video called systematic churning plan, and then try to get the best value out of it. So when you talk about for example, only existing funds or new funds, I will always say it should be a combination of existing funds plus new funds, provided it meets your goal. Thank you very much. All investments that you're going to make are subject to market risks. So nothing comes without risks. For example, whether you are going to invest in real estate, that will come up with some certain risks. If you are going to invest in gold and silver, the prices are fluctuating like anything every day. That is also coming up with risk. If you are going to invest in direct equities, obviously, yes, it is going to have risks. Same thing with mutual funds. All investments are subject to market risks. Go through all the scheme related documents. Make a decision after going through all the documentation. And whenever you have doubt, you please reach out to us. get your doubts clarified, get complete clarity before making any investments.